Hello and welcome to Anantam IAS. Today we are going to have a part 3 discussion in the series of budget and economic survey videos that we are making. If you remember, in the first two videos we have picked up certain themes from the economic survey like state of Indian economy, fiscal developments, monetary management and banking sector developments. As a continuation of these topics, in this video I am going to pick up two new themes. One is financial market developments and other is state of inflation, right? Just like any other video, in the previous videos we have discussed certain MCQs. Even in this video, I am going to add certain MCQs as and when the topic is done, we are going to solve them. As I always say, please try to answer these MCQs and write down your answers in the comment section. And you are free to ask any doubts if you have any in the comment section. I am going to reach out to you. Okay. First and foremost, the first theme is financial markets, financial market development. First of all, to understand the trends in the financial market developments, you need to know what is a financial market. Financial market is a market where financial instruments like equities, debts, derivatives, all these are traded. That means through trading of these kind of financial instruments, financial market mobilize the savings into investments. Financial market acts as a conduit or a channel to mobilize the savings and channel them into investments. It raises money from those people who have surplus to those people who are in need of it. A strong financial market is very important for the investment creation in any economy. So that is why if you want to understand the nature of the economy or the trend of the economy, you can look at the financial market performance. And this topic is very important for prelims because of late there has been increasing tendency in the from the UPSC to ask questions from the financial markets, right? So this is about the financial market. Before understanding the trends, let me introduce you to the basic topics like primary market and secondary market. Primary market and secondary market. What are primary markets? See, in financial markets are broadly categorized into primary market and secondary market depending upon the nature of the transaction. Primary markets are those markets where the listed companies sell their securities directly to the investors, where new securities are traded, unlike in the secondary market where already existing securities are traded. For example, let's say there are certain companies which are already listed on the stock market. Let's say A, B, C are few companies which are listed on stock market. Let's say listed companies. These companies issue all kinds of securities in the financial market like shares, bonds, anything. And these financial securities are purchased by investors in the market. By purchasing the financial securities, we are creating a capital in the primary market. But whereas in the secondary market, already those securities which were purchased by these investors, these are traded. That means it is like a second hand market. So these investors further trade with other investors. That means already issued securities are traded rather than like in the primary market where new securities are issued, right? Both primary market and secondary market are important. The role of the primary market is to create the capital. So this is important for capital creation in the first place. That means this is where new securities are issued and which are purchased by the investors, thereby creating the capital. So primary markets are very important. However, secondary markets are equally important because secondary markets play a very complementary role to the primary markets by providing liquidity to these securities. Liquidity. What is liquidity? The ability to sell a security in the secondary market. For example, if these investors do not have any assurance of selling these securities which they have purchased from these listed companies, then there is no demand for the securities from these companies. Investors purchase the securities either to hold them with them or they can sell it in the secondary market. So the better the liquidity, the better the demand for these securities in the primary market. So having a proper secondary market, liquidity market is very important for the capital creation in the first place. So both primary markets and secondary markets are important and they play a very complementary role in mobilizing the savings into investments. Right? Now, looking at the performance of both primary market and secondary market in India, as per economic survey, there has been a resilience in the financial market performance. That means economic survey said that in India we have had a very good financial market year. In fact, the reason why I use the word resilient is because of the global uncertainty, the background in which the financial markets have performed. As we have already discussed in previous videos that there has been tariff war when American government had imposed tariffs on India's exports. It definitely impacted the export performance of certain manufacturing companies. So that definitely impacted their stock performance, their performance of their stocks in the stock market. The same thing goes with the visa restrictions imposed by the American government. It also impacted the performance of the IT companies in the stock markets, right? And not only that, we have seen increasing FPI outflows from Indian market. That means all the foreign capital which came to India through foreign portfolio investments, they pulled out their investment from Indian market in the backdrop of depreciating rupee. When rupee value depreciates, the rate of returns that are earned by the foreign investors in the stock market may come down. During such instances, the foreign investors would withdraw or pull out their investments from the Indian market. So despite visa restrictions and tariff war and also weakening of the rupee which resulted in FPI outflows, India had shown great resiliency in terms of financial markets both in primary and secondary market. So you must be wondering why. What are the reasons for this good performance of financial markets? First and foremost, all the foreign portfolio investments which were pulled out of India were balanced and compensated by the increasing domestic investors. The domestic investment had filled the place vacated by the foreign investors. This could be possible because of multiple reasons. First and foremost reason is inflation. The receding inflation. Inflation has been declining in India. If you remember in the last lecture we have discussed about how inflation reduced from almost 6% to 1.7% in the span of 12 months. When inflation reduces, which means the consumption expenditure is going to be reduced and this leaves with more amount of savings in the hands of the public, that will be increased, that has resulted in increasing investment in the financial markets. And also the infusion of liquidity by the RBI, or you can say the expansionary monetary policies taken by the Reserve Bank of India. Again, in the previous lecture we have discussed about how Reserve Bank of India had infused more than 2 lakh crores through open market operations, more than 2.4 lakh crores through dollar rupee currency swap, and also how cash reserve ratio has been decreased from 4% to 3%, and how repo rate was reduced by almost 125 basis points. That means all these were part of the expansionary monetary policy that was taken by the Reserve Bank of India, and that has resulted in increasing liquidity in the market, which resulted in increasing investment in the financial markets. So reducing inflation, infusion of liquidity, and also GST rate cuts. GST rate cut also resulted in increasing savings among the consumers, and personal income tax rationalization. Last year, the government had introduced a new tax regime under which the tax rates are relatively lower if the income tax payer does not want to entail his exemptions that are given to him under Income Tax Act. So if you want to forgo, or if you want to leave your exemptions that are entitled to you, then you can pay a lesser income tax. So all these reasons influenced increasing participation of the domestic investors in the financial market. So the visa restrictions, the tariff wars, and the FPI outflows in the backdrop of receding value of the rupee, all these things did not much impact the financial markets much, right? So this is the broad trend of financial markets. Now let's go deeper into it and let's find out how the primary markets performed in the last 1 year, right? So in the primary markets, where uh, listed companies or unlisted companies issue their shares to the investors, one important that is clearly mentioned by this economic survey is the increasing IPO activity. IPO refers to initial public offer. Initial public offer. So, before understanding the trends in the IPO, where I can expect a question this time, because this is very, very important. Before understanding the trends in the IPO activity in India in the last one financial year, let us understand what is IPO. Initial public offer refers to issue of new shares by a new listed company. That means a company which is listed on the listed on the stock exchange is issuing its shares for the first time. It is issuing its shares for the first time. That is known as initial public offer. That means that company has gone public for the first time. That means if if you're listed on the stock exchange and if you have issued your shares to the public at large, then it is known that the company has become public, right? So in India, the IPO activity increased very significantly. In fact, as per the economic survey and also as per the SEBI chairman, India has become the leading destination for IPO activity. That means, in terms of numbers, India is the number one in terms of number of IPOs that were issued in the financial markets. See, in 2025, in the year 2025, more than 360 companies have issued their IPOs. That means more than 360 companies have listed themselves and issued their shares for the first time to the public at large. And not only in terms of the number, but also in terms of the value, India is third in terms of values. That means the amount of capital that was raised through this IPO issuance is around $23 billion, $22.9 billion. So it is one of the leading destinations of IPO. Indian financial market has become one of the leading destinations of IPO activity, both in number and also in value. This is very, very important for prelims. Okay. If you remember last year, there was a question on increasing FN futures and options activity. So a similar question can be asked. Okay. Now, one more interesting trend in the IPO is that within the IPO, the share of offer for sale is around 58%. That means it is closing towards 60%. So what is OFS, or offer for sale, and how is it different from a normal IPO? And what are the concerns with respect to increasing share of the OFOs in the IPO market? So IPOs are generally two types. One is fresh sale, other is offer for sale, or OFS. Okay. What is fresh sale and what is offer for sale, and how are they different from each other? See, as we have already discussed, what is IPO? You're issuing the shares for the first time. Issuing the shares for the first time. Now, this can happen in two ways. Fresh sale, that means a company which has been listed recently and it is issuing the shares for the first time, and it has issued new shares, not the existing shares. What is it? For example, let's say, I'll give you an example. Let's say there are 10 individuals who came together and started a business. These 10 individuals are known as promoters of the business. Okay. So each one of them had contributed to the capital by 10 crore each. That means all the 10 promoters together contributed a capital of 100 crores, and each of them holding 10% of the share in the total capital. Right? And after they started their business, they ran it for a few years and it is going very well. After few years, they wanted to expand the business, for which they needed more capital. Right? Now they start off listing their company on the stock exchange. That means they wanted to go public. That means they want to raise the capital from the market, stock market, by issuing new shares. Let's say their original capital is 100 crores, each one of them had contributed 10 crore, and each one of them is holding 10% shares in the company. Now they want to raise 100 crores more by issuing new shares. That means the existing shareholding capacity of these 10 people, 10 promoters, is going to be come down to 50%, and rest of the 50% shares are going to be sold in the market by capitalizing or by mobilizing 100 crores of capital, thereby expanding the size of the capital of the company. So fresh sale means the company is going to be listed on the stock exchange and issuing new shares and raising new capital or fresh capital. It is raising fresh capital, extra capital. So the original capital size of the company was 100 crores. Now by issuing new shares, it raised 100 crores more. Now the capital size has been increased from 100 to 200 crores, and the shareholding capacity of the existing promoters have been reduced by half. Clear? So this is the normal IPO activity, which is called as fresh sale activity. The other is offer for sale. Unlike in the fresh sale category, here no new shares are issued. The existing shares of the shareholders are sold in the market. For example, in the previous example, I said that there are 10 promoters, each contributed 10 crore each. Together they contributed to a capital of 100 crores, and they ran the business for a few years. And after that, there are two promoters who want to exit the business. There are two promoters who want to exit the business. That means they want to sell their 10% stake each. That means together they want to sell off 20% stake from the company. So who is going to purchase it? So then they thought of going to the public. That means they thought of listing their company on the stock exchange and selling the 20% stake to the public and raising the 20 crores loan, 20 crores capital from the public, and whatever the money that was raised is going to be directly credited into the accounts of these two promoters who wants to sell off their stake. That means these two promoters who wants to exit the business are selling their stakes to the public at large. So since no new issues are shared here, the capital size would remain the same. That means they're selling only the existing shares of the promoters or the existing shareholders. So no new shares are issued, and existing shares of promoters are sold. Since existing shares are sold, no new capital creation is done. That means the capital size would remain the same. So no new capital creation. No new capital is created. right? So under fresh sale, you are issuing new shares and raising more capital. This will help in expanding the business of the organization. But in the offer for sale, they're selling the existing shares of any promoter, and they're replacing the old capital with new capital. That means the capital size is not being expanded. That means it is not going to help in expanding the business activity. Now, in this background, let's see the context. In India, IPO activity has been increasing. As I said, both in terms of number and in terms of value, Indian markets have become number one destination for IPO activity. However, most of them, around 60% of them, have only gone through OFS route, not normal IPO route or fresh sale route. What is the problem here? The problem is more and more companies or promoters are exiting their business. So offer for sales are not creating new capital. The existing shareholders are only selling their share, but they are not expanding their business. This is a cause of concern. So this is what the financial experts said. See, as primary market booms, exit by the promoters and investors are accelerating. This may be good for the markets but not for the companies. So we cannot blindly believe that increasing IPO activity is good for the economy. We also have to look into in which category the IPO activity is mostly coming from. If it is mostly coming from offer for sales, it is not going to create new capital. It is not going to expand the existing business, right? So yes, IPO activity is being increased. However, increasing share of OFS is a cause of concern. So this is important trend, and this I'm expecting a question on this topic in this year prelims. Okay. Next, other important trend is widening or the broadening retail participation in the capital market. Okay. What is retail participation? That means in India, in the stock markets and the financial markets, we have seen increasing participation from the individual investors. Retail investors are those individual investors or those household investors which are not considered as institutional investors. That means not banks or any other financial company. Individuals like you and me who are increasingly investing in the stock market. Okay. So this increasing individual investment in the capital markets is clearly seen in the evolution and changes in the composition of household savings. So what is this savings? What is this savings? First and foremost, the savings made by an economy is generally measured by gross domestic savings. Gross domestic savings. Gross domestic savings means out of the total national income, if you subtract the consumption expenditure, you will be left with gross domestic savings. That means this savings is going to be reallocated as investment in the economy through financial markets. Okay. Out of this gross domestic savings, who are going to contribute to this gross domestic savings? There are three important stakeholders in the economy who are going to contribute to the gross domestic savings. One is households. Second, private companies or corporates. Private corporates. Third, government. These three entities contribute to the gross domestic savings. Out of these three stakeholders, it is the households who contribute the highest or the predominant share of the total gross domestic savings. Around 60 to 65%, 60 to 65% of the total savings is being contributed by the households, and whereas it coming to the corporates, it is hardly 30 to 35%, and the rest is coming from government. That means government contribution to the gross domestic savings is very minimal. It is hardly 1%, 2%, it is less than 5%. Sometimes it may go even negative as well, depending upon the revenue expenditure portion of the government. Okay. So anyways, these two are not very important. This is very, very important because household savings change the mood of the economy in a year. Now, these household savings comes in multiple formats. household savings generally come in two formats. One, either physical savings or financial savings. Physical format or financial format. Under physical format, generally they invest in gold, silver, or any precious metal, or they do invest in real estate like a plot of land, a house, etc. This is a dead investment. That means if you're spending on a plot of land or a gold, it is not getting into the financial market, which can be utilized as an investment creation in the economy. What is important is this portion, financial savings portion, right? What is financial savings? Financial savings refers to either cash or deposits, right? Or investment in equities or debt instruments like bonds, or they can investment in insurance, pension, etc. So these are various ways in which the households channelize their financial savings, if not physical savings. As I said, physical savings are not very important because it's like a dead investment. That means if you're investing in the gold or a plot of land, it is not getting into the economy. That money is not getting into the economy in the form of deposits, equity, where it can be utilized for an investment, where it can be utilized for further capital creation, right? So financial savings, cash, deposits, equities, debt instruments, insurance, pension schemes, etc. Okay. Traditionally, out of all these formats, most of the households used to channelize their savings in the deposits. Traditionally, deposits is the first option for your savings, either fixed deposit, recurring deposit, any kind of deposit. However, of late, there has been a change in the behavior of the households with respect to their financial savings. Now, they're increasingly investing in equities or shares, either directly or indirectly. That means they themselves are directly saving or investing in the shares of the market, shares that are issued in the stock market, or they're purchasing mutual funds through systematic investment plans, SIPs, and these mutual funds are investing in the shares of the stock market. So either directly or indirectly, most of the household financial savings are being diverted to equities in the market. This is one interesting change that has been seen or witnessed in terms of household financial savings. That is clearly mentioned in the economic survey, and it is a good sign. See, earlier in financial year 2019, let's compare from 19 to 25. In 19, 46% of the total household financial savings used to go to the banking deposits. Now that has been reduced to only 39.6%. That means around 40%. There is a decline in the share of the deposits out of total household financial savings. Now look at this. Earlier, only 15% of the annual household financial savings used to go to the equities. Now this portion increased to 23%. So the share of deposits have been reduced and the share of equities have been increased. This happened mostly after pandemic. There has been increasing registrations of demat accounts, increasing subscription for systematic investment plans issued by fund managers, fund managing companies through mutual funds. There are multiple reasons, because with increasing income, people's risk perception or risk appetite has been changed, and also with increasing financial awareness through promotion activities taken by the SEBI and other mutual fund companies, they have also been accustomed to this idea of subscribing to the mutual funds, or they themselves directly investing in the shares, right? So this is very, very important. Reducing share of deposits and increasing share of mutual funds, or increasing share of equities. Okay. However, this comes with a risk. See, deposit is a risk-free investment. You deposit the money in the bank, and the bank is going to give a certain standard interest rate, but your money is safe. But you cannot say the same thing with respect to the investment in the shares in the stock market. The value of the share is very volatile. It may go up and go down, right? So with greater retail participation in the stock market, there is a greater responsibility for the SEBI, isn't it? So for that reason, in the backdrop of increasing retail participation in the stock markets, to give extra powers to the SEBI to protect the interest of the retail investors, a new security market code was introduced. See, there is another reason why this securities market code was introduced in the parliament, was in the backdrop of the corruption allegations that were leveled against the ex or the former SEBI chairperson. Madhabi Puri, the former chairperson, was subjected to multiple criticisms with respect to her interests or investments of her family members in certain companies, which shows there is a conflict of interest with respect to her position as a SEBI chairperson. So, in the backdrop of increasing retail participation, where the risk associated with is also increasing, and also this corruption allegations that were leveled against the SEBI chairperson, in the backdrop of these two contexts, a new SEBI or security market code was introduced. It is still a bill. It is in the parliamentary committee stage, but there are high chances that this bill is going to be passed in the present parliament session. So if it is going to be passed, you can expect a question in this year prelims. Okay. So first and foremost, let us find out what is this Security Markets Code 2025 is all about. So generally, the security markets are governed by three important legislations. One was Security Transactions Regulation Act or Security Contracts Regulation Act. It was enacted in 1956. You don't have to remember these acts. This is important right now. The first act was Security Contract Act 1956, which regulates each and every security transaction that takes place in the market. Number one thing. And in 1992, the government or the parliament had introduced another act known as SEBI Act. This was introduced after the most infamous Harshad Mehta scam, where they believed that there was a need for a regulator to protect the interest of the investors against these malpractices. So then they introduced a new board to regulate the malpractices and protect the interest of the investors. So SEBI Act 1992 was the second act which governs the security markets. And there is another act which was introduced in 1996 known as the Depositories Act. The Depositories Act regulates the depositories in the market. What are these depositories? See, earlier the securities were given in the physical format, in the paper format. Now the securities are transacted or sold in digital format or dematerialized format. For that reason, you have to maintain a demat account. So the demat account is maintained with a depository who is going to store your securities which you hold them, which you own them. See, just like a bank account, it's just like a bank account. If I want to save my money in the bank, then I need to open a bank account with a particular bank. The same way, all the shares, bonds, and any kind of securities that are generally purchased by me in the stock market is stored in dematerialized format or digital format with these depositories. So for the seamless transactions of these financial securities like selling, purchasing, and keeping them as collateral for any transaction, the markets needed depositories. So for that reason, the government introduced Depositories Act in 1996. So there were three acts. One is Security Contract Act 1956, second is SEBI Act 1992, and Depositories Act 1996. All these three acts are parallelly regulating the security markets, often leading to a lot of confusion. This fragmented statutory regime of the security market is going to be removed with the introduction of a single uniform act which is going to regulate each and every aspect of the security market. That act is Security Markets Code 2025, which is still in the parliamentary committee stage. It is yet to be passed, but it is most likely to be passed in this budget session, right? So what is this new act? This new act or new bill or new code has replaced all these three laws and it not only replaced them, it retained most of these provisions of these three acts and combined them in one single code. Apart from that, given the increasing retail participation and in the context of corruption allegations against the former SEBI chairperson, they wanted to refurbish the SEBI, Securities and Exchange Board of India, which is very, very important. So it has given certain new powers to the SEBI to function independently and to protect the interest of the investors in the market. So let us find out what are the new provisions that were introduced through Securities Market Code 2025. Okay. The first and foremost is with respect to the composition of the SEBI, composition of Securities and Exchange Board of India. See, earlier SEBI comprises of 11 members. Okay. One chairperson, two officials from Ministry of Finance and Ministry of Corporate Affairs. That means one official from Minister of Finance and one official from Minister of Corporate Affairs, and one official from RBI, Reserve Bank of India. Together four, and earlier there were five officials or five members which were nominated by the central government or which are appointed by the central government. Now that number increased to 11. Now we have 11 central government appointment. 11 members are going to be appointed by the central government. Earlier this number used to be just 5. Okay. Now the composition of the SEBI has been expanded to 15 now. Earlier there were only 9 members, now it increased to 15 members. This is important. Why this was done? The idea was to increase the size of the SEBI by making new appointments from people belonging to different fields to enhance the expertise of the SEBI to function it relatively better. Right? So this is about the composition of the SEBI that was introduced as per the Security Markets Code 2025. And the second important function is the separation of powers of these members. See, the main purpose of the SEBI is to protect the interest of the investors in the market. That means to regulate any sort of wrongdoings, any sort of malpractices like insider trading or leakage, having conflict of interest, corruption, this and that. Right? So for that reason, SEBI was given with certain quasi-judicial powers and quasi-investigation powers. That means SEBI can take up any malpractice and issue show cause notice to any company, any market participant, and ask them to appear for investigation. Once investigation is conducted, they also have certain quasi-judicial powers. That means they can issue penalty and award any sort of punishment to the person who is responsible for this whole fiasco. Right? So earlier a single individual can be an investigation authority and also adjudicating authority. But now the Security Market Code bifurcated these two authorities. The investigating authority, adjudicating authority was bifurcated. That means earlier same member can be appointed by the SEBI to look after a malpractice, to investigate and also to take an action by giving a certain amount of punishment or penalty. However, this is against the principles of natural justice. You can't be the investigative agency and you can't be the judge in your own case. Right? For example, in any civil or criminal case in the normal criminal law or civil law, the police department is going to investigate a particular case, and it is the judge or the judiciary department which is going to adjudicate the investigative department. That means it is the judiciary department which is going to provide penalty, it is going to award punishment. Right? However, the same member doing both the jobs in the SEBI is against the principles of natural justice, and this may often leads to the corruption. See, if I'm the investigating agency and I'm also the adjudicating authority, there is a chance of investigative bias, or there is a chance of corruption activity there. So for that reason, a same member cannot be appointed both as investigating and adjudicating authority. If a member of the SEBI is investigating the report, there is another member who is going to be appointed for adjudicating on the investigating report and giving a certain punishment, right? So this is to improve the efficiency and governance of the SEBI, okay, and addressing the conflict of interest in the SEBI. See, the SEBI members who are appointed by the central government, and some of them are chairperson, and some of them have been appointed by the Minister of Finance and Minister of Corporate Affairs. See, these individuals may have certain financial investments in certain companies. However, such financial investments in any company should be properly declared as and when they become a member of SEBI, to avoid any conflict of interest in the future. For example, if SEBI is investigating any malpractice in a particular company, and they come to know that one of its members have an investment in that particular company, isn't it a conflict of interest? So in such cases, the member should come forward and mandatorily disclose the any financial investment in such companies. So mandatory disclosure of financial investments or any kind of association with the company. That means either the member or the family members may have direct or indirect relation with the company, or they are associated with the company in any position or any stature, then it is a conflict of interest. These members should come forward and express their conflict of interest and recuse themselves from either investigation or adjudicating that particular malpractice, right? If at all, if there is any member whose association with any company is giving a conflict of interest or leading to dilute his functions as a member of SEBI, then central government can remove that person. So central government can remove the persons in case of conflict of interest, right? You will be able to understand why this provision was introduced if you get into the case of former SEBI chairperson, how the family members of the former SEBI chairperson, they involved in certain companies where they prove certain companies where certain malpractices were done allegedly. So this is another improved governance mechanism that was introduced under Security Markets Code 2025. And independence to function, to enable the SEBI to function independently. The Security Markets Code had given certain powers or autonomy in terms of appointing the staff members, in terms of fixing the salaries, in terms of prescribing the qualifications for certain positions in the SEBI. So that is why SEBI conducts its own examination. SEBI conducts its own qualification, it prescribes its own qualification framework. So this kind of independence with respect to hiring staff is very important to work independently of any government interference. So there should be a certain buffer between the central government and the regulators like SEBI. See, this is on par with any other regulator. See, regulators are supposed to work independently without any executive influence. So if they've got autonomy in case of appointing staff and their removal, qualification framework, salaries, everything, they have got the independence, right? And investor grievance redressal mechanism, the Security Market Code 2025 categorically mentioned about establishing a separate investor grievance redressal mechanism in the backdrop of increasing retail investment in the capital markets, right? And This is also very important. It introduced a new term known as market infrastructure institutions. What are these market infrastructure institutions? Any institution that is directly involved in the entire financial markets, like stock exchanges, like NSE, BSE, Gift City, all these are stock exchanges. And depositories, as I said, what are depositories? These are institutions which provide the depository services by safely storing the financial securities in their dematerialized format. And clearing corporations, all these are known as, what are clearing corporations? Those corporations which clear the transactions, the security transactions. So all these are important for the seamless functioning of any financial market. This market infrastructure is necessary, but who is going to regulate this market infrastructure? It is the SEBI. It is the SEBI. The Security Market Code had given powers for the SEBI to regulate all these market infrastructure institutions, a new word that was introduced in the code. So if at all there is any question where it says that market infrastructure institutions, don't get confused. It is talking about all these stakeholders that are involved in the financial market functioning by providing a certain service, right? Here, the SEBI was given extra powers to regulate these market infrastructure institutions, and it was made mandatory for these market infrastructure institutions to register themselves with the SEBI. And if there is any need, SEBI can devolve certain powers to these market infrastructure institutions to make rules and regulations for the efficient functioning of the financial markets, right? So that's it about the securities market code, where you can expect a prelims question this time, provided this code is going to be passed in this budget session, right? That's it with the financial markets. Then let's solve certain questions. Consider the following statements about primary market activity in capital markets. Okay, primary market activity. India is one of the leading markets for initial public offerings, both in terms of the number and value. Yes, India is number one in terms of IPOs that are, number of IPOs that are issued in India in the financial market, and also in terms of values it is number 3. So it is one of the leading markets for IPO, both in terms of number and value. That means the amount of capital that is raised through this IPO issues, right? Second, in an offer for sale, the company receives the proceeds from the sale of shares, thereby increasing its capital base. Read it again. In an offer for sale, the company receives the proceeds from the sale of shares, but not going to increase the capital base, because in an offer for sale, the existing shares are sold. The promoters may exit from the company by selling the shares to the public. So it is not going to expand the capital size. The capital would remain the same. So this second statement is wrong. That is a cause of concern, right? Offer for sale accounts for the majority share of IPO activity in India, right? 58% of the total, around 60% of the total IPO activity is coming in the form of OFS category, offer for sale category. So the first and second, third statements are wrong, is right. So the answer is C, right? So these kind of questions can be expected in the prelims, right? Now the next question, consider the following statements about household financial savings in India. Again, very important. Bank deposits continue to be the major share of the annual household financial savings in India, right? If you see, yes, we have definitely seen changing or evolution in the annual financial savings behavior. The share of the deposits have definitely come down, but it is the predominant share. Even now, around 40% is going towards deposits only. But it is declining, but it is the major, it is continued to be the major share of the annual financial. Yes, the statement is right. The second statement, the share of equity instruments in overall annual household financial savings in India has increased over the last 5 years, right? It has increased from 15% to 23%. So both the statements are right. The answer is both 1 and 2, C. Again, this is also important. Again, this, consider the following statements about Securities Market Code 2025. Very, very important. The code enhances the composition of Securities and Exchange Board by increasing the number of whole-time members appointed by the central government. Right. It increased from 5 to 11, increased to 11, right? Second statement, the code permits the same official to exercise both investigative and adjudicating functions in the same case to expedite the resolution process. Wrong. The investigative powers and executive powers, adjudicatory powers were bifurcated, right? Third statement, a 1 year cooling period has been imposed on farmer members, barring them from taking up employment with any market participant or government body immediately after demitting office. This is right. I forgot to add that here. Please add that point here as well. To enhance the independence, a cooling off period was introduced for those members who have worked in the SEBI. They cannot be immediately take any employment with the government or any other market participant like any other company after retiring from SEBI, after demitting their office tenure as a member of the SEBI. So, post employment cooling period was introduced for 1 year. This is to again improve the independence. So, yes, the third statement is right. So, the answer is 1 and 3 B, right? So that's it with the financial markets. I have picked up the most important themes within the financial market topic, which are important for prelims. Okay. Now the next theme is inflation. Very important, because significant changes were made in the inflation. Even yesterday as well, there was a CPI series was in news. So we're going to discuss about it for the first. But first, let's talk about inflation. So what is inflation? Inflation refers to a price level, general price level in the wide range of commodities and services in the market for a certain period of time. Basically, it is price rise. Inflation is measured in terms of CPI and WPI. There are two indices in India which we follow. One is WPI, Wholesale Price Index, which measures inflation for only goods and commodities at the wholesale level, whereas there is another index known as Consumer Price Index, which measures inflation at consumer level or the retail level, which traces where it traces the inflation or the changes in the price level of both goods and services. Right. Now let's see how WPI and CPI performed in the last one financial year. So if you see from 2024, the CPI reduced from 4.6% to 1.7%. The same way, WPI also reduced from 2.2% to 0.04%. 0.04. So there has been significant decline in inflation in the last 12 months. Very important. That is why it is very important for this year prelims. So before understanding anything, let us first of all find out the reasons for inflation. Reasons for declining inflation. See, you may get a question, a conceptual question based on the reasons, because there are certain demand reasons, there are certain supply side reasons. So if the reasons are because of the demand side, we call it demand pull inflation. If it is because of the supply side reasons, that inflation is known as cost push inflation. So let us find out how the inflation declined in the last financial year. First and foremost, the most important factor was reduction of food inflation. Reduced food inflation decreased CPI significantly. See, in India, especially in CPI, the highest weightage is given to the food commodities. In the old CPI series, the new CPI series came into existence only from yesterday. Okay, till yesterday there was old CPI series. In the old CPI series, even in the new CPI series, the highest weightage is given to the food and beverage section. Food and beverage section in the CPI, old CPI, was more than 40%. More than 40%. So any drop in the food prices will have significant impact on the overall CPI. consumer price index because of the significant weightage it was given in the CPI. But the question is, why was there a reduction in the food inflation? What happened with respect to the food inflation? What happened in Indian economy that reduced this food inflation? The number one factor was the supply side factor, that is monsoon. A good monsoon. In 2025, monsoon was pretty decent. See, monsoon determines the inflation. Monsoon determines the food production in the Indian economy, where almost 50% of the cropping acreage in India is rain dependent. It is rain dependent. It is not covered by any stable irrigation. So, a good monsoon will always have a positive impact on the price levels. That means it may keep the price levels at a regulated level, right? And second thing, there are certain policies taken by the government. They also contributed to the reduction of food inflation. One such policy was the buffer stock policies. Buffer stock policies. That means the government procures and stores food grains for multiple purposes. One purpose is to provide the food grains to the 80 crores of population under Pradhan Mantri Garib Kalyan Anna Yojana. That means through PDS mechanism, it provides either subsidized or free food grains to a certain section of the population, thereby protecting them from the food inflation. So, apart from these basic cereals like rice and wheat, the government has also been increasingly procuring certain other commodities like pulses, where you can see inflation most frequently. In pulses, we see price volatility. So, to make sure that the farmers are going to sow these pulses, to grow these pulses, the government had assured them that it is going to procure them from at a MSP and maintain them as a buffer stock and release them in the market whenever there is a reduction in the supply of these important commodities. So, good buffer stock management had regulated the prices of pulses. See, procurement of 6.5 lakh metric ton in the previous season. 6.5 lakh metric tons of pulses regulated the prices. Regulated the prices of pulses in the market. So, buffer stock policy is another important component or important factor behind this reduced food inflation. And other is the trade policies taken by the government. What kind of trade policies are we talking about? The government often imposes or changes the basic customs duty on certain food commodities that will eventually have an impact on the food inflation. Let's take the example of edible oil. In India, despite having the suitable agroclimatic conditions to grow wide range of edible oil crops, we depend upon oil imports. We depend upon imports for almost to meet 50% of our consumption demand. 50% of our edible oil consumption is met through imports. So any change in the prices of this crude edible oil in the global market is going to have an impact on the food inflation. So whenever there is increasing in the global crude oil, global edible oil prices, immediately the government would react by reducing the customs duty. That's what happened last year. In 2025, the government reduced basic customs duty on edible oil from 20 to 10%. Customs duty reduced from 20% to 10%. So this is also important. So trade policies like customs duty reduction on important customs duty reduction on imports, right? So because of all these policies, the food inflation came under control. When food inflation, which has almost 40%, more than 40% weightage in the CPI, obviously reduction in the food inflation would have a significant impact on the overall CPI, right? And apart from that, there are other reasons for reduction of inflation. Overall CPI is global crude oil prices also reduced. Global crude oil prices also reduced. When global crude oil prices reduces, it is going to have a direct impact on the inflation in the Indian economy, because in India we depend upon the imports for important oil, important commodities that is used in the manufacturing of most of the goods, and also the used in the transportation of the commodities. So any change in the global crude oil would have an impact, direct impact on the prices of petrol and diesel in the Indian economy. So when the petrol and diesel prices have come down, that would have direct impact on the overall CPI. So this is another impact. And GST rate cuts. GST rate cuts. As we have already discussed, one of the significant changes to the GST that was undertaken in the 2025 was the slab rationalization. So it introduced two rate structure. One is merit rate and other is standard rate. 5% rate refers to merit rate and 18% rate refers to standard rate. Most of the fast moving consumer goods, agricultural commodities and other food based products, they were brought under 5%. And also all those electronic instruments and other instruments which were under 28% were brought under 18%. So by reducing the indirect taxes, the cost of most of the products have come down. That has resulted in reducing CPI, consumer price index, right? And another interesting thing is the base effect. The base effect was very high this time, and that is why the inflation appeared to be very low. So what is base effect? Base effect refers to the distortions in the current inflation figures due to extreme variations, either high inflation or low inflation in the corresponding period in the last year. See, CPI or the consumer price index is generally measured on year basis. That means the price level this year in this month is compared with the price level of the this month in the previous year. That means right now we are in the month of February 2026. If you want to compare this CPI or the price levels in 2026 February, you have to compare with it in February 2025 prices. So when the last year prices increases significantly or decreases significantly, if the price levels in the last year, corresponding period in the last year is very high or very low, it will have an artificial impact on the inflation levels in this year when we compare them on year basis, right? When the price level in the previous year corresponding period is very low, any small or moderate rise in the prices may appear to be very high inflation. On the other hand, when the last year price levels are very high, then even a significant increase in the price rise this year may not appear to be very significant, but it appears to be moderate. So last year the inflation was very high. Last year in October and November 2024, October 2024 and November 2024, the inflation was around 6% and 5.5%. That means they were above the 6% band, 6% mark, right? So that resulted in reducing the inflation by this year December, this year November, because of the base effect, right? So these are the reasons for low inflation. One, food inflation. Second, global crude oil prices. Third, GST rate cuts. And also fourth, the base effect, right? So you can expect a current affairs question or a static question based on this topic, reasons for inflation. Okay. Now there is another interesting trend that is seen in the inflation, which is the divergence between the headline inflation and core inflation. The divergence between headline inflation and core inflation. To understand the divergence, first of all, let me introduce you to this concept of headline and core inflation. Headline inflation, core inflation. So basically, what is headline inflation? Measuring the inflation of all the goods and services is headline inflation, Whereas removing certain volatile components like food and fuel from the measurement of the inflation, then we arrive at core inflation. Why food and fuel are removed from the measurement of inflation? Because these two commodities in India are very volatile. As I said, more than 50%, around 50% of the cropping acreage in India is rain dependent. That means it is not protected by sustainable irrigation methods. So any change in the monsoon, like any erratic monsoon, may impact the food production, and that will lead to food inflation. The same thing with respect to the fuel. India depends upon the imports for its crude oil. So any geopolitical tension or any supply chain disruptions with respect to the crude oil may have a direct impact on the inflation. So for these two reasons, which are not within the control of the Indian economy, they tend to be very volatile, either vagaries of the market or weather volatility. Either ways, that would impact the inflation. So that is why these volatile components are removed aside to understand the overall price levels in the economy. We arrive at core inflation. So headline inflation is inclusive of all goods and services. It measures inflation inclusive of all goods and services, whereas the core inflation excludes food and fuel commodities, food and fuel components, right? The headline inflation enable you to understand. Generally headline inflation is relatively volatile compared to the core inflation, which is relatively stable. Headline inflation is volatile in nature because you have food and fuel components, whereas this is relatively stable. See, you can clearly see this from. So the core inflation, the orange curve shows the headline inflation. So the orange curve reduced, whereas the blue curve is almost relatively stable. So generally headline inflation tend to be volatile, core inflation tend to be relatively stable. And what is the purpose of measuring core inflation separately? I understand headline inflation is more volatile because of the food and fuel component, but why do you want to remove it? The idea of measuring the headline inflation is to understand the immediate impact on the cost of living of the consumer. That means it measures the changes in the immediate, it measures immediate changes in the cost of living. Immediate changes in cost of living. So these statements can be asked in the prelims as in the prelims. Okay. Immediate change in the cost of living. That means whenever the cost of living is changed immediately, whereas core inflation is measured to understand the long-term price levels. Long-term price levels. Long-term trends in the price levels. See, if you see, the core inflation is almost relatively stable, but headline inflation reduced. So the reduction in the headline inflation would have an impact on your cost of living, on your budget of the consumers, right? Generally headline inflation, see, this difference of headline versus core inflation is more relevant to the developing economies compared to the developed economies. Why is that? It is more relevant to the developing economies. Why is it? The reason is, in developing economies like India, our food production is always volatile because we fail to provide proper irrigation. So the food security or the food production is always volatile. We depend upon the monsoons and natural factors for our food production. And also we have high dependency on fuel on the other countries. So we don't have supply chain resiliency. Because of these reasons, we often see that in developing economies like India, we tend to divide this headline and core inflation. And not only that, there is one more interesting factor. Whenever the income levels are going to be increased, remember this, whenever the income levels are going to be increased, there we see reducing share of the consumption expenditure on food. So that is why in developing economies, the food is given very less weightage compared to in developed economies, the food is given less weightage in their CPI compared to the CPI in developing economies. So with increasing economic development, the food budget share is going to be reduced and the weightage given to the food components in the CPI is going to be reduced. So even if there is a volatility there, it is not going to impact the overall inflation that significantly. So that is why this differentiation is all the more important for developing economies like us, right? So this is the headline inflation and core inflation. Now let us understand the trends in this headline inflation and core inflation in the last 1 year. If you see, compared to the last January, where the headline and core inflation are relatively at the same level, around 4%, and later on the core inflation went on to increase to 4.62, whereas the headline inflation decreased to almost 1.3%. So there is an increasing divergence between the headline and core inflation. What are the reasons for it? One of the significant reasons which we already discussed was food inflation. The food inflation significantly declined and the same level of decline was not seen in other commodities. And other important thing is there is increasing prices of gold and silver. Gold and silver prices, especially precious metals, have increased. They touched their peak in the year 2025, right? There are multiple reasons why the cost of gold increased in the global market, because amidst the global uncertainties, people shifted their investments towards these precious metals because there was uncertainty. The currency rates are being depreciated and no country is sure of giving proper returns on their government securities. So in the global economy, investors are choosing the precious metal for their investment and hedging their investments. So that increases the prices of the gold, because gold and silver, they are limited commodities in the supply. Now when the gold and silver prices increased, the core inflation slightly increased. On the other hand, food inflation declined. So that resulted in widening of the gap between core inflation and headline inflation. Understand? So this is with respect to the trends in headline versus core inflation, where you can expect a question this time again. Right. Next, the new CPI series which was introduced just yesterday, right? The government introduced new CPI NSO under Minister of Statistics and Program Implementation unveiled the new CPI series. Okay. What is this new CPI series and how is it different from the old series? Let us briefly discuss about the changes that were introduced into the new CPI series. The first is change in the base year. Change in the base year. Okay. The base year was changed from 2012 to 2024. 2024 is the new base year for CPI, Consumer Price Index. This can be a question this time. Why there was a change in the base year? See, for calculating any WPI or CPI, we trace the price levels among certain goods and services. For that, we fix a certain basket, right? So, based on the consumption patterns, certain goods and services are listed in the CPI basket, and we trace the performance of the price levels among these goods and services that were listed in the basket. However, the old CPI base year was 2012. In the last 13 years, there has been significant change in the consumption pattern. So we need to update the consumption basket, CPI basket, as per the latest current consumption patterns. For that reason, they changed the base year as per the recent RBI's household consumption survey. Household consumption expenditure survey, which was conducted in 2023 itself. So they use that data to change the base year from 2012 to 2024, and by using that data they also change the basket of goods and services. Earlier, under CPI there were 299 items, both goods and services, but they increased to 358 items. So there are 350, what is it? 208 commodities. There are 208 commodities, whereas there are around 50 services. 50 services. 208 commodities and 50 services, right? So they increased the number of items to 358 as per the latest expenditure survey. Clear? Next, new items were introduced, old items were removed from the consumption basket. See, the reason why we changed the base year, why we changed everything is because we have to find out whether the change in the prices among these commodities and services are having any impact on the consumer at the end of the day or not. Right? Whether it is impacting the cost of living on the consumer, whether it is impacting the purchasing power of the consumer or not. Now, for that, you need to reflect the consumption patterns properly. So that is why all the obsolete items, that means those items which are not in use anymore, should be removed, and the new items which are in use right now are supposed to be added into the basket. So as a process, certain new items were introduced. See, certain old items were removed like CD, DVDs. These kind of items are removed because they are no more in use. They have become obsolete. Now the new items, with respect to the new items, they introduced very important thing. This can be asked in the prelims this year. They introduced housing rent in the rural areas. House rent in rural areas is also introduced. See, earlier under CPA rural component, for housing the weightage is 0. That means it was assumed that earlier the consumption of house rent in rural areas is almost negligible. So house rent is a concept which is an important item of expenditure only in the urban areas. However, this has been changed in the new series. Even in the CPA rural component, house rent was given a certain weightage of 5%. Okay, the weightage number is not important, but this is important, right? Second, they also introduced certain new items like uh, online media services. Online media services like increasing consumption of OTT, increasing consumption of any other online media services, OTT, Spotify, YouTube, cloud, everything. So they were also introduced, and new energy items were introduced. New fuels like CNG and PNG were also introduced, which were not there earlier. Only LPG was there. Now CNG and PNG were also introduced. So these kind of new items are introduced to reflect the current consumption expenditure patterns, right? So these are major changes that were introduced in the new CPI series. And other important change is with respect to the weightages. Weightages of goods and services have been changed. Now this is important for the exam. Let's see how these weightages have been changed. In the old series CPA 2012, the biggest component was given to the food and beverage section. That means this is 45% was given to food and beverage. Here we have seen significant change in the new series. In the new series, it was reduced to only 36%, 36.7%, from 45 to 36, almost decline of 10%. Decline of 10% was seen or visible in the food and beverage. Now the question is why? What are the reasons for this decline? Why the share of food and beverage section was introduced? There are multiple reasons. One important reason is that Engel's law. One important reason is Engel's law. Okay. What is Engel's law? Engel's law says that with increasing income of the individuals, let me repeat it again. With increasing income of the individuals, the share of the food expenditure in the overall consumption expenditure is going to be reduced. See, I'll explain you through an example. Let's say there is an individual who is earning 10,000 rupees per month. Now, if he is spending around 4,000 rupees for food, What is the share of food budget in that overall consumption expenditure? 40%. That means if the individual is spending 10,000 rupees per month and he's he's spending 4,000 rupees only on the food budget, so 40%. Now let's take an example of a person who is spending 1 lakh rupees per month. Out of 1 lakh, at the most the person may spend 20,000 rupees on the food. 20,000 rupees. Then the share of the food budget becomes reduced to 20% of the total consumption expenditure. Now let's take another example. A third individual who is spending 2 lakh rupees or who is earning 2 lakh rupees per month. Probably he might be spending, let's say, 30,000 rupees on the food budget. Then the share becomes only 15%. So when the income of an individual increases, the food budget and the share of the food budget and the total consumption expenditure is going to be reduced. That is Engel's law. Why is it relevant for the CPI is that in India, in the last 12 years, we have seen significant increase in the per capita income. When per capita income increases, then it reduces the share of the food budget or food component in the overall consumption expenditure. So that is why the weightage given to the food and beverage section has been reduced to 36.75%. Remember? And there is another reason is that in India, the government is protecting its 80 crores of population through PDS by providing them subsidized food grains. So, in the backdrop of robust PDS mechanism, probably the price level or the changes in the prices of these food commodities may not have an impact on almost 50 to 60% of the population. And also, the government is government is taking multiple other measures. So, irrespective of the food inflation, a certain important 50 to 60% of the population is not impacted by it. So, for that reason as well, the weightage given to the food and beverage section has been reduced, right? So basically this is most important factor in it. This is the most important changes that was introduced in the CPI new series with respect to the weightage. Coming to the other section, with respect to the fuel and light, with respect to the fuel like housing, water, electricity, gas and other fuels, all of them were combined. They were given 17.6%. That is the second most important weightage. See, the classification has also been changed. In the earlier CPI 2012 series, the classification was different and now the classification is different. This new classification is as per the international standards. It is as per the international standards. There is a classification methodology, classification framework that was introduced by the UN Statistic Division, and India has adopted this statistic division. So that is why it is very difficult to compare all of them exactly. But the housing weightage has been definitely increased because earlier the rural housing rent component is zero. It was zero. Now it has increased to 5% weightage. So there is an increasing in the housing component. So this is the new weightage of CPI. Please go through it. You may expect some questions on the weightage section as well. So these are the important changes with respect to the inflation in the last 1 year. So you can expect question on any of these three topics. So let's solve some questions based on it. The first question, which of the following may result in a low inflation rate in Indian economy? 1. Good monsoon. Yes, when there is good monsoon, it is going to ease the supply side factor behind the inflation. So yes, good monsoon, that reduces the food inflation. Second, declining crude oil prices in the global market, right? When crude oil prices are going to be declined in the global market, then these benefits are going to be passed on to the prices of oil, prices of petrol and diesel. So this will definitely have an impact on the inflation. So that is going to reduce the inflation, right? Third, high price levels in the corresponding period of the previous year. That means very high base effect. What is high base effect? If the price levels are very high in the previous year of the corresponding period, then even if there is a significant price level increase that is not properly accommodated, then it appears to be a very low inflation. So all these three factors are important, and these three factors are also relevant for this year inflation trends in Indian economy. So you can expect either a trend based question or a conceptual based question on the causes of inflation, right? Next, look at this. Consider the following statements about new consumer price index series released by the Minister of Statistics and Program Implementation. The base year has been updated to the year 2024, right? It has been updated. Second, the basket of items widened for comprehensive coverage of goods and services reflecting the current consumption pattern. As I said, it was increased to 358 items from 299. So definitely to comprehensively reflect the current consumption patterns, the basket of goods and services, the basket of items have been widened. The third statement, the rural house rent component has been excluded due to the increased coverage of rural housing schemes of the government. This is a tricky statement. This is wrong. This is how the UPSC construct the statements. Whenever it says, it gives a fact like this, it is substantiated by the reason as well. So the whole statement may look like a proper sensible statement, but don't walk into such traps. The rural house rent component was introduced for the first time in the CPI by giving it with a weightage of 5%. Earlier it was 0. Now it was introduced. So the third statement is wrong. The share of food and beverage has declined in the new series. Yes, the share of food and beverage. Let me remind you, even though it declined, it is the major, it still continues to hold the major share in the total weightage. Right? So the answer is 1, 2 and 4 only. Right. Next, this Angel's law, question on Angel's law. Which of the following best describes the concept of Angel's law? What is Angel's law? When income levels increases, the consumption of the food, the share of the food expenditure in the total consumption expenditure is going to be reduced. Right. Decreasing the proportion of poverty due to the high GDP growth rate. Wrong. Increasing income inequality due to high GDP growth. Wrong. Decreasing in the proportion of income spent on the food due to increasing in the income levels is C is the right answer. Next, in the recent Indian experience, these kind of questions also can be expected. In the recent Indian experience, headline inflation fell below core inflation. Remember, headline inflation fell below core inflation. What are the reasons? Headline inflation and core inflation, there is a divergence. What are the reasons? See, effective buffer stock management moderating food prices. Of course, when food prices reduces, you see divergence between headline and core inflation. So, right. Second statement, pass through of global crude oil price decline to domestic fuel prices. Again, when fuel prices decline, you also see divergence between headline and core inflation. So second statement also makes sense, right? Look at the third statement. Sharp increase in the prices of precious metals like gold and silver. When gold and silver prices increased, the overall inflation, core inflation increased and headline inflation decreased. So obviously this is also reason. So all these three were the reasons behind this divergence between headline and core inflation in the last 1 year. So 1, 2 and 3, D is the answer. So that's it with respect to the inflation. So today we completed these two important themes, financial market developments and also inflation in the Indian economy. Very, very important for the prelims. So I hope you enjoy the discussion. Please reach out to me. Please type your doubts in the comment section if you have any. I'm going to reach out to you. So that's it with the discussion. We'll meet with a new discussion and new themes soon. Till then, see you.